So our next presenter, Darryl Nagel, needs really no introduction to the members of the ATAA, but I'll give him a brief introduction anyway, just so he doesn't get too offended. Darryl Nagel has been investing and trading since 1986. His trading journey started with call options over BHP shares and has included virtually all trading instruments. The Wave theory led to learning and teaching GAN technology. He taught the use of CFDs when first introduced into the Australia from the UK. His first presentation to the ATAA was in 1996 about the psychology of trading. A copy of that presentation is available on the ATAA website. Darryl worked for 3 companies in Australia and overseas, teaching strategies using CFDs, shares, Forex, options, and futures. He has his own education organisation teaching various trading psychology methods. Currently, he is a postgraduate student with Central Queensland University, undertaking research on the application of probability theory by retail traders to reduce emotions and make superior trading decisions. Today, he trades CFDs. So without any further ado, Darryl, I'll stop sharing and you can take the screen.
Thank you so very much, Paul, and I will share my screen now. There we go. Hopefully that works. Good. Well, good evening, everyone, and welcome and thank you so much for attending this presentation on options. It follows on from the presentation that was given last month, and I just thought I'd cover a few things that wasn't covered. When I say wasn't covered, it was more of an introduction, and it was a very good introduction. And in fact, the slide that you're seeing now is from that presentation. And I thought it's good because the way it was expressed, because he said that options can be thought as insurance for the stock market, because they share 2 key similarities. And because options are a sort of an acquired taste, they're not for everyone, I know, but I've always thought of them, when I say easy, there's a lot of depth to them, and that's what interested me, why I became interested in options, because there are so many different strategies. However, having said that, the other side is that you can get too bogged down, I think, in the theory. To me, trading is experiential, not intellectual, and unlike everybody else, you can overthink everything. So just looking at the insurance concept, that when we take out an insurance policy, the insurance company sells us a policy, we pay a premium, and that policy does expire, and typically it's at the end of 12 months. So the options that are traded on the market are very similar in that way, and I think it helps to look at the concepts. He also mentioned that one options contract is worth 100 shares. That wasn't always the case. When I first traded options over shares, one contract controlled 1,000 shares. So it's much easier, I think, these days to trade options. And he was talking about buying call options and buying put options. And that's a fairly straightforward approach to options. And he wanted to talk about 3 key things: time to expiry, and when we look at something called the Greeks, that's theta, price, and volatility. They are 3 important aspects of options. The one that I'm going to talk about tonight in depth is the first one, time to expiry. And price speaks for itself. Volatility, I know purists look at volatility, and rightly so. I try to make it as simple as possible for me, and as a result of that, I may not be trading as skillfully as I should if I'm ignoring volatility. But we might be able to talk about volatility another day. But the big concept I have with trading is having an edge. And what is an edge? A trading edge? It's a defined advantage. That's really it. But the emphasis is on the word defined. And I like to talk about the casinos because they do have a mathematically calculated and proven edge, and it's defined by a calculation called expected value. Excuse me a sec. And they are able, of course, to control the game that are played. And so it's easier for them to create an edge. Insurance companies have an edge, and that's based on the theories of probability. And both of them, both the casinos and insurers, probability theories rank very highly. So the question for all of us, including myself, is, do we have an edge? And to me, it's critical. So is it mathematically, if you do have an edge, is it mathematically provable in the same way as expected value, as with casinos, or at least definable in writing? But it should be quantitative. What I mean by that, not qualitative, it really needs, I think, to be mathematically defined. And I know this is sort of punching us right through the eyes, but if you do not have an edge, are you gambling? And there's nothing wrong with gambling, but I really think we have to be honest with ourselves. And because we can be trading without an edge and still enjoy it. I'm up in Queensland at the moment, and when I'm up here, I go to a tavern nearby my home here, and you go through with a lot of taverns and clubs. To get to the dining room, you've got to go through the pokies, where the pokies are, the gambling room. And I remember asking one of these people playing the slots, the pokies, I said, why do you actually play the pokies? And I thought they might have been said something rude to me. And the answer was really interesting for me, because the answer was, well, I find this being fun. And I thought, isn't that interesting? Because we can, I think, have fun trading without an edge. But I think if we're looking for a financial gain out of trading on a consistent basis, then we must have an edge. There's no doubt about it. So I'm going to identify an edge in trading options, and this is why I've always liked trading options, because the edge is certain, it can never change, and it's consistent in every way. So you might think, oh, gee, this is the holy grail of trading. No, it's not. However, it does, options, when I say uniquely, almost uniquely, does have this edge with us as traders. And you can use this edge. It's nothing complicated about it. So your trading edge with trading options is simply time decay. And as we know, or often looking at the Greeks, it's theta. And here is a graphic representation. You may have seen this before. This is looking at an options contract with 90 days to go. And you can see the rate of decay as time elapses. And the important thing, I think, to notice about, and that's it, time is always elapsing. This is your edge. But I just wanted to put that line on because it's just not a linear thing. It is important to understand the way in which time does actually decay. So with the last 30 days, the time aspect of options reduces 2/3 in the last 1/3 of the options contract itself. So if one was going to buy options, and that's how I started off, I was buying options, I'd be looking in this area here, the first month, because you can see time decay, whilst it is going down, it's not as dramatic as down here. So in buying options, to me, I don't have an edge. You can still make money. I'm not saying you can't make money, but to me, you don't have that edge as far as time decay is concerned. So what I like is that time decay works in your favour as a seller of options. Now, I know not everybody trades on the long side, that is to buy first and sell second. And I understand that, and it seems alien almost, counterintuitive to sell first and then buy back second, because we're always looking at an object like a share. You know, how can you sell something you don't own, and what do you do with it when you buy it back? But of course, all we're talking about are simply orders. And so with Forex traders, you may be buying one currency, but you're always selling the other. Also, if you're selling one currency, you're also buying the other. But it mightn't become as obvious, I think, to Forex traders that they are trading on the short side. And of course, with other instruments, we tend to favour being a buyer. So what I'm saying with options, there is an edge against us. That's the problem. So we're talking about selling options, whether they're calls or puts. We're going to talk about both tonight. And so all it is that the first order is to sell. That's all there is. Now, the second order is to buy that contract back, or you allow that option to expire for no value, provided it hasn't been exercised by the buyer. So we'll look at the rights and obligations in a moment. But that is it. And so one of the advantages with options is you don't necessarily have to close out the position as you would with your CFDs or shares. So yeah, you're paying commission on the way in, you're paying commission on the way out. And if you're not exercised with an option, if it's what they call expiring worthless, you've only got one lot of commission. So upon selling an option, this is at the very beginning, you receive a premium. So that's really like the insurance company. The insurance company receives the premium. We, as the insured, pay the premium. So with selling options, with the seller receiving the premium, the seller has an obligation to sell the underlying instrument. We'll talk about shares. So if it's an option over shares, and I'm sold an option, then I have an obligation to sell the shares, the subject of the option, if the buyer exercises their right to call for the underlying, to call for the shares. And that has to be exercised, that right, prior to expiry of the option period. Because once the option period is over, that's it. They can't exercise any rights. Well, there's no rights. So the buyer of the option pays the premium and has the right, but not an obligation, to buy the underlying instrument prior to expiry. So this is important from the buyer's point of view. You're not obliged to buy anything. It's up to you. You've got the right, but not the obligation. And of course, with most buyers of options, they're not wanting to purchase shares or purchase anything, the underlying. All they're wanting to do is make money from the buying in and selling out. So tonight we're talking about selling what they call naked options. And here's the big NB, and this is so important. Again, Paul has shown you the disclaimer, and I want to emphasize that tonight we're not encouraging you to trade options. So just one second, I thought there might have been something in the chat box, sorry. I don't mind taking questions as we go through. So when you just sell an option, it's called a naked sale, but it is extremely, extremely risky, as the seller has an unlimited liability should the price of the instrument go in the opposite direction. So if I'm selling shares over, and I'll be talking about Commonwealth Bank, if I'm selling, say a call option over Commonwealth Bank, and we'll see an example of this, there is no limit to where the price of Commonwealth Bank shares can go. Obviously, on the other side, we're selling a put. I guess the limit is that the shares can't go past zero. That's the only limit. But yeah, where Commonwealth Bank shares are now, it'd be an incredible liability. incredible risk to be a naked seller. So I just want to emphasise that there is nothing I'm saying tonight that is going to encourage you to trade options. I just want to let you know how I do it. But and just on this point, because I say that trading is experiential and not intellectual, find a platform where you can trade a demo account, because I think it really helps to trade rather than just be looking at the theory. I think we can get too caught up in it, and that's one of the advantages of the ASX trading game, to be able to get that experience without being liable for any money. Okay, let's move on. So selling naked puts may have less risk. This seems to be the opposite of what I'm saying. When your strategy is to own the underlying instrument, you might say, what the hell is all that about? I'm going to come to that. This is something I have commonly done. This part, I have never, ever been the naked seller of options. Ever, ever, ever. It's too risky, and I'm not prepared to take that. So we'll address the second part in a moment. Okay, so we're talking about the underlying instrument being shares, but it can be other instruments as well. So I've said that my strategy is to sell a call option over shares, and just stopping there, I'm just talking about call options at the moment. We'll talk about puts in a moment. So I'm looking at a level of resistance as a place where I may look at selling a call option, not by itself. There's going to be a combination in a moment, but I'm just what I'm looking at as a technical analyst. Why would I be doing anything with options? And it's the same as with shares or whatever. We're looking at technical indicators. We're looking at a level of resistance together with other indicators. And as you know, you've probably heard me say this before. Always remember that indicators don't move price. It's price that moves the indicators. So here's my favourite, Commonwealth Bank, and this is from a few days ago. I particularly wanted to capture this at this stage, and it's only a few days ago. The price, you can see, was going sideways, and that's an interesting pattern, and we can see how we can make money when the instrument is trading sideways. Normally, you can't make money. You get whipsawed in and out, but I'm going to show you a very simple strategy, and we're going to build that strategy as we go along. So here we've got a level of resistance. So I'm alert, and the market has tried to get past this level of resistance for quite a few days, and we can see with the stochastics. Let me see if I can. This has all changed. Isn't it interesting how wonderful they change everything? I can't get. Oh, where is it? Sorry about this. Spotlight. Is that what I want to do? There we go. So you can see here that the market was going sideways, and the stochastics was suggesting the market would go down. Well, it did go down for a little while, but then came back up again. Here's another level of resistance. The momentum is saying to go down and up and down. So, but here's this fairly strong, I would have thought, level of resistance, and I would be tempted to sell call options. What I was saying before is how dangerous it is to just be a naked seller of calls, because let's see what happened after this. And I was just looking at this divergence, another indicator, not only the level of resistance, but you can see there is divergence between price and the stochastics. But that's what happened with the price of CommBank. So you can see that if I was selling options here, the premium on the call options has increased in value. So I've got to buy it back at a higher price than what I've received it. So I need to pay more than I received to buy the call options back. This is an example of how dangerous it is just to sell naked calls. So we talk about call spreads. We're looking at the probability that the price will go down. The emphasis is on the word probability, and that's because of our technical indicators. And what we're looking at is the strategy is designed to provide protection for this naked sold call. We've got to have protection to avoid that calamitous that we saw before. There are two legs to the strategy. I'm assuming in this example that it's an index. You don't have to worry what the index is. It's only just for example. The index was saying we're looking at it at 44.61. So what I'm going to do is I'm going to sell a call which is higher in price. So it's out of the money. I'm not going to go out of the money, in the money, and at the money tonight. So this is what they call an out of the money call option. And I will receive $550. Don't forget, we're talking about 100 shares, or parts of with the index of so $10 or whatever it is with an index times 100. So as protection, though, we're saying we need protection for a naked call. So I buy a call at a higher strike price. This is my protection. This is hedging, basically, pure and simple. I do have to pay out $290 for the price of protection. Now, just stopping there, insurance companies do this. They do not take on the whole of the risk of the insurance policy. They reinsure, that is, they lay off the risk. And in fact, Warren Buffett's companies from almost its inception, his fund has always focused on reinsurance, and that's been obviously there's huge other things that he's been involved with, buying businesses basically. But this is really a hedge. I don't know if anybody can remember or anyone went to the races. I used to when I was young. And back in those days, you don't see them much now at the track, but a bookmaker will probably take a lot of bets on the favourite. Some people who are in Sydney may remember Bill Waterhouse. He was well known for taking on the favourite. But what they would do is they would lay off part of that amount that they were holding with another bookmaker or bookmakers, so the risk wasn't as high. So basically, this is nothing different. We are just simply getting protection, pure and simple. So because we're buying protection, that does reduce the net amount that we're going to receive, $260. And some people might say, oh, yeah, I'm not interested in that. Well, we'll talk about that another time. So just looking at it, we've got the index at 44.61. We're selling the 44.75 call, but this is the protection with it's a bought call at 44.85. Okay, and in this particular case, the index closed at 44.64 at the expiry of the option. So just looking at the closing price in regard to the options, so it did go up, but it didn't go up substantially. In fact, it didn't hit the strike price of the sell call. So this would have expired worthless. In other words, the buyer would not have exercised the right because the strike price is higher than the index. And certainly this one would expire worthless. Now, in this particular case, people might say, oh, look, why should I have bought this protection? That cost me $290. I would have had $550. But please, that is the danger, that we get greedy. All you've got to do is stick to your trading plan. That's all you've got to do. Now, the other side are credit put spreads. So we looked at call spreads, and this is on the basis that the probability that the price will go up. So this would be in a case where we've got a level of support. So we're looking at the balance of probabilities that the price, having hit this level of support, will then go up. So we're looking to, again, obtain protection. There are two legs to the strategy. Again, we're looking at the same index. Here we're selling a put. This is going to be below the price of the index at 4445 for 570, and we're selling a put at a lower strike price for 260. That's our protection again, and that gives us our net of $310. In this particular case, again, the index obviously finished at 4461, and you could, sorry, let me get that. There's the price, 4464. So in this case, the index didn't even go down. It did go up. That was the probability the price would go up, and of course it did. But it only had to go up a little bit. So this put option expired worthless, and of course that one would be too. Okay. Then the third strategy I like, and this is really one of my favourites. There's advantages and disadvantages with every strategy, and in this one, we're looking at the probability the price will consolidate. So we just saw a few moments ago with Mary's presentation that oil has been consolidating in price, and you can see plenty of charts of the shares that you look at, CFDs or whatever, where price consolidates, and typically you stand aside, I'm presuming, you're looking at buying long, so you're looking at the market going up and liking the trends. This is where the market's just consolidating, and wouldn't it be good to be able to make money when the market is also consolidating? So the strategy is simply the combination of what we've already talked about. Nothing different, nothing more complicated than just dealing with both of those. And so once you understand the two spreads, you understand iron condors. So there are 4 legs to the strategy. Again, we're looking at the index at 4461. We're selling the higher strike price call at 4475, as we saw before. This is our protection at 4485 for $290. On the put side, we're selling a put below the index price to bring in 570, and this is our protection at 260, which we saw before. Now we get a net of 570. Now we're talking. Now we've got something decent. And so provided that the price stays within the range of 44.45 at the bottom and 44.75 at the top, we keep our 570, because this is looking at consolidation. Excellent. So that's as simple as that. Now, options expire on the 3rd Thursday of the month, or we do have something called weekly options, and of course they would expire on the Thursday. And when you looked at that, the chart showing the expiry of time expiration, you can see why people would be drawn to weekly options, because we saw that the price was going down quite rapidly towards the end of a 3-month option. And that's why weekly options are now very popular, so people can be trading weekly rather than monthly, and our edge is even stronger in that regard. So as I said before, selling naked options is extremely risky because of the unlimited liability should the price go in the opposite direction. However, counterintuitively, selling naked puts may have less risk, provided your strategy is to own the underlying instrument. So if I want to buy Commonwealth Bank shares, as we'll see in one of the slides, you can just simply buy them. But instead of buying them, what if I sold a put over Commonwealth Bank shares? And this is what I'm talking about here. I've done it a few times, and what it is that you're buying really the shares at a discount, because it's the strike price that you have to pay if you're exercised, but you've already received a premium. So it's really like looking at buying shares with a discount. There is a disadvantage. If I wanted to buy the shares and I just sell puts and don't buy the shares, what can happen, of course, is the market goes up and not down. I won't be exercised. I receive premiums, but perhaps I really wanted to own the shares. So that there is a disadvantage. So here's looking at Commonwealth Bank up to a day or so ago, and I'm saying I'd like to buy some more CBA shares to hold for the long term as an investor. I have to emphasise that. I am not looking to buy the shares to sell them. I don't care what the price is of my Commonwealth Bank shares. I'll peek, but I don't really look that often because it's irrelevant. I'm not, in some cases I will tell you where I did sell some Commonwealth Bank shares, and it's quite embarrassing for me to admit that, and I'll explain in a moment. But can you see there have been some times when, for example, the market has consolidated, and really, when you're looking at consolidation, it's really a Davis box, isn't it? Anyway, that's the idea of the iron condor. But what we're talking about here is I'd like to buy some more shares. So I'll be looking at a time where, for example, the market might be going sideways. I'm selling a put, and it wouldn't be the end of the world if I got exercised here at this price. Or here, the market's going beautifully. I may be exercised here at this point. And that's fine, because I want to hold the shares as a long-time investor. And of course, so I can buy them, as I said before, or I can sell a naked CBA put to buy them. And so don't forget, one option contract controls 100 shares. So as the seller of a put option, I receive a premium. So if the price goes, excuse me, if the price actually goes above, it doesn't end at this, sorry, let me get it right. So if the price goes above my put option strike price, perhaps I haven't worded that well. So at expiry, the price is above my put option strike price. The put option would not be exercised. I keep the premium, but I don't have any shares. But if the price remains at or below the put option strike price, then my put option will most likely be exercised. I will be obliged to buy the shares, which is what I wanted. And of course, one question is, well, why not just simply buy them in the first place? But I believe, as I said before, I'm buying them at a discount. The next is a very important question, I think, is do I care if the price of the shares go down after I purchase the shares? And I can see there's a question here in the chat. I should have asked this. Is the Australian option market today liquid? In the past was not liquid, I heard. Darren, you are 100% correct. It is not as liquid as we would like it. However, I'll come back, remind me of that. And that's a very, very good question because that's why trading the American market can be more lucrative. However, because I tend to only look at Australian shares, it doesn't worry me about the liquidity, and I'll tell you why in a moment. I might as well just address it now. Why not? So when you're looking at CommBank, what you do is you look at the bid and ask spread and just see how wide it is. It is the fact that many of the market makers have left the industry. Now, you might say, well, who are these market makers? Well, because of the nature of, and the lack of liquidity, but it's in the same in the States, the exchange requires market makers to make a market. Now, for some reason, they don't really want to be very generous with us at all. So the spread can be quite wide at times, but not always. So where I've got a spread of, say, $10 bid, $20 ask, or whatever it is, if there's a wide spread, you don't accept you don't trade at market. You put an order in, you become a market maker somewhere perhaps in the middle. So you take with Commonwealth Bank options, they are fairly liquid, but not every day and not every time of the day. But generally speaking, you can get set satisfactorily, Darren. But you're 100%. They're not really that as liquid as we would like them to be. But it's not that you can't trade them. You can. Okay. Whoops. I'll just get rid of that. I'll just go back. Sorry, I think I missed something. Let me go back. Okay, so do I care if the price of the shares go down after I purchase the shares? Absolutely not. I don't care. And you might say, well, why don't I care? So as a long-term investor, my focus is not to make money from the purchase and ultimate sale of the shares. My focus is simply twofold: to receive dividends and franking credits. That is it. That's the only reason I hold these shares. I may never sell my remaining lot of shares at all. There's no point. That wasn't my intent. My intent is to get dividends and franking credits. And when I first bought Commonwealth Bank shares, they were about $5, whatever. When you look at the dividends that you're getting today, yeah, that's about an 80% return each year. I know that's not enough for some people. Some of you, make more than 80%, but it's enough for me. But the franking credit is so powerful, it really is, and they are calculated as 3/7 of the dividend. And I have my shares in a self-managed super fund, but and so there's some benefits there. So the franking credits come from the Australian Taxation Office. We are one of the few countries, I don't know any other country, there probably are one or two other countries that have this franking credit system. And it was brought in at the time of Bob Hawke and Paul Keating. Just one second, I'm just taking a drink. And the purpose of this system is to avoid double taxation. So a company, when they make money, they've got profits, they pay tax on those profits, but then the net amount is then distributed either 100% or less to the shareholders as dividends, and the shareholders would then pay tax on those dividends. So really the taxation office is getting on the same amount of money, tax from the company and then tax in the hands of the shareholder. That was the purpose of these franking credits. Why they're so powerful is, as I say, I have it in a self-managed super fund, and I'll explain a little bit more in a moment. So I've chosen Commonwealth Bank for the strategies because the dividend comes with 100% franking credit. So not all companies, the dividends come with a 100% franking credit. They go from 0 to 100%, and it just depends the amount of tax that the company has paid as to the amount of the franking credits. So I only apply the strategy to those companies that have 100% franking credits attached to the dividends, because that's really my aim. Now, I hold the shares in a self-managed super fund, and the reason for that is this, that in pension phase, you do not pay tax on income or on capital gains. No tax at all. And the reason for that was the government was wanting people to be self-sufficient. And so if you are freed from taxation, then your super account will increase faster. There is a bit of irony with this, and I know the Labor government tried to change the rules, and of course they weren't elected because this is under Shorten. They wanted to change the rules whereby people like me, I get a check from the ATO being a franking credit, but I'd pay no tax. So in a way it's unfair. So the idea was that the franking credit would cover the tax, but this anomaly was brought about by John Howard, in fact, many years ago. And I guess self-managed super funds weren't all that popular in those days. So I don't know how long this will last. A government, I think, will have to close this loophole, but well, it's not a loophole, it's just what the law is, but why not just take advantage of it? So you can trade options within a self-managed super fund, and you can trade many instruments, but there are some important provisos. And please, this is not legal advice or financial advice. But first, the trustee of the self-managed super fund must give power to the trustee to deal in options. I haven't got it on the slide here, but you do have to have a risk management document as well. And you have to really satisfy yourself of the rules around self-managed super funds. There can be traps for young players. Yeah, please always get advice. I always get advice myself, even though I think I know it. And what you can do, what's interesting is you can get a private advice from the ATO. What better place to get it? Because even if your financial advisor says, yes, Darryl, you can do X, Y, Z, if the Commissioner of Taxation doesn't like that, well, then too bad. I'm going to have to comply with what the Taxation Office says. So I urge you to look at what the ATO say, and if you've got any doubt, please get an advice from the ATO itself. So as I say, I'm not giving legal or financial advice, I'm just sharing what I do. And that really brings me to the end of that part of the presentation. I've got a little bit more. I just wanted to divert just for a moment, just take another sip of water. I was asked during the week, an ATA member wanted me to talk about a GAN strategy, and he saw the GAN strategy in a presentation I gave back in 2017, and to be honest, I've probably forgotten about most of them, but I just wanted to show you where on the ATA website there are some presentations that I've given over the years. So you go to resources, you go to the resource library folders, and I'm indicating there to go to member resource library. Now, it is a little bit off-putting with Club Express because you can see that it says 0. But ignore that. That's just a bit of not a gremlin, but it's just the way that the site has been structured. So we go into member resource library. Then we've got, in this member resource library, you've got, first of all, presentation by speakers. I'll come back to that. And then presentations by group. And so we're going to go into that. And here is the Bigelow network, a substantial amount of presentations, 48 presentations. That is an incredible resource. And I'm a fan of Bigelow method. You don't have to necessarily follow it, but there's so much religiously, but I think there's some really valid strategies within that. And of course, the Forex network for those people who want to trade Forex. I come down to this one, the Holy Grail Trader. There are 8 videos there, and one of the videos that this person was asking me about is there. And it was so most of it is about psychology, but this was one about a trading plan, how important it is to have a trading plan. And I was talking about swing overlays in that. So there are 8 of those. I did some presentations under the heading of the Metastock user group. There are 19 there, and they're on various aspects of trading. So you don't necessarily have to own Metastock to get a benefit out of that. Anyway, I just thought I'd show that. But then when we go, so there are those 8 that I was telling you about. These are some of the ones in Metastock. But when you go to presentation by speakers, you just go to N to Q, and there I've got 24 presentations in there. So the main reason for sort of saying that is there are some things in there that you might find of help. And of course, one of them here is trading through a self-managed super fund. And I did actually, it's interesting, profitably trading Bitcoin. And you can't, using just ordinary technical analysis, but I was using futures because I only believe in trading something that goes through an exchange. And so there's a few things there that you might like to look at. That brings me on to just a further option strategy, and I won't talk about this at length because I know the longer you talk about options, it gets quite overwhelming. I've got here, Graham, to buy the underlying using puts, would you sell at a strike price, be under the current price? The answer is yes. Yes. Well, I see, that's a good question. Let me think about that for a moment. Okay. Let me just think that through, because that's what I've normally done. But now that you asked the question, Graham, let's have a look at the other two ways that we might tackle this. So if I was selling a put option at a strike price below the current price, that is an out of the money option. If the strike price is roughly the same as the current price, that would be at the money. And if I bought if I sold the put at a strike price above the current price, that would be in the money. This is a really good question, Graham. Thank you. This is what I love about these presentations, because people do ask some excellent questions. So of those three, out of the money, that's below the price, at the money, which is at the price, strike price is the same as the actual price of the shares or whatever, or in the money where the strike price is above the current price, which one do you think you would get the most premium from? The most time premium from? Which one do you think? Anyone like to put in the chat box, which do you think would be the better one? The best one, better than the three. You're going to have a 30% chance of getting it right. Well, we won't dwell on it. It's at the money. The best is to do it at the money. That's where you get the most premium. However, if you're really reticent to own the shares, which you shouldn't be doing this anyway, then there's more likelihood that you will be exercised. So for those, when you're looking at the strike price out of the money, where the strike price is below the price of the shares, that's out of the money. The premium isn't as large, but the chance of being exercised might be lower. So if you're really only wanting the premium, then you could do that. But as I've said, it is so risky just to do that without owning the shares. So what will happen, of course, is you can continue with out of the money ones. You can continue to get the premium until the price does go down. And then you actually own the shares, but you're not unhappy because you've already set aside money. Adrian thought out of the money. I think it's at the money, but look, out of the money, that's the ones that I've been talking about. You still get a good return. Okay. Anyway, thank you for that. Thank you, Darren, and thank you, Adrian. Darryl, any third-party option analysis software such as Option View for US market for Australian market? I don't know, Alwyn, to be honest. Any third-party option analysis? Oh, software. Oh, sorry. Well, I use Metastock. I can show you. This may or may not be the analysis you're talking about, because I suppose Metastock is really not an analytical tool. It's more just a charting tool, isn't it? But there is something in the option scope of Metastock that I think is worthwhile, and I will show you, perhaps if we've got time, the screen, if I can bring in Metastock. I haven't started it on my computer, so I'll have to get it up and running. But there are some nice things in the Metastock, but of course it can be in other ways as well. But I think to answer your question, Alwyn, the answer is no, I don't. But I can always find out for you. So I'll give everybody my new email address, and we can follow it up. So thank you very much for the question. That's good. Thank you. Okay, right. Let's close that. So what we're talking about is something I have to be honest, I hadn't paid much attention to until I started to do some research for this presentation. And it's 0 day to expiry options. So this is an option where you're opening and closing the position within the same trading day. Now, that does make total sense with what it is that we're talking about tonight, because we're talking about time decay. So time will really eat its head off, if that's the right terminology, on the last day, because it's going to expire. So by hypothesis, there's not going to be any time left, and so time decay is really rapidly increasing. So they take advantage of the price movements of a soon-to-expire options contract, and unlike traditional longer day trading strategies, the zero-day to expiry options focuses on short-term gains by leveraging option contract volatility and time decay. But that can be a bit of a trap for younger players and older players with the volatility on that last day. I'm going to tell you what I would do if I'm going to do this. This is actually a screenshot of MetaStock, and look, I'm not saying this is what you should obtain, but if anyone doesn't have MetaStock and you would like to have a little bit of a squeeze for nothing, well, I'll give you my email address at the end. But there are other platforms that you can use as well. But I just want to show you this, a blow up of that panel there. And so you can see that you can actually obtain those instruments where the contracts expire today. But then it's the next 7 days, 30, 90, 365, or all of them. I might as well just go to this point. Weekly options are now available, both here in Australia and overseas. And I like that because it means every week you can get an income. Of course, the reason why people want the 0 day to expiry options is they can get a premium every day. I would be worried about doing it on the day of expiry because of the volatility. I would look at it probably on the day before the last day if I was going to do that. And so, as I said, the advantage of it is that you've got options that are expiring, every day we're talking about, whereas we can do it every week and, of course, every month, typically. Okay, so what they're trying to do is get profit from a rapid price change as the options contract approaches expiration. And by doing it within the same day, they can capitalise on the small price movements with the aim of getting a good return. But it does require, as I say, careful analysis, precise timing, and deep understanding of market dynamics. It can be very volatile. It can be very volatile on that last day. So you don't really require as much capital to trade them, and the outcome obviously is known on the same day. You don't have an overnight risk. I mean, that's one of the problems, isn't it, when we're trading other things, is that overnight risk, that we can have gapping in the market, and in fact, the price can gap below or above our stop loss or our trailing stop. So we actually are donating to the market more than what we expected because of that overnight risk. With these options, of course, the premium is about an eighth of the 45-day options. American options and European options are important to understand. Here in Australia, uniquely, when I say uniquely, unlike America, obviously in Europe they are available, they are here. It is important to understand the distinction between American options and European options. With American options, and it has happened to me many times, I have been exercised before the time for expiry. So it could be 5 days before, 20 days before. So when you sell an option, the buyer has the right, but not the obligation, to purchase those shares. And the seller is obliged to sell them. And you may not want to. European options are beautiful in this regard because the buyer only has the right on the last day of the option to exercise that right. So particularly when I'm doing some dividend, we shouldn't call it stripping, but dividend stripping is actually legal. You do have to comply with some rules. There's that 45-day rule to get the franking credit. It isn't actually 40 days at all. 45 days, if anyone's ever traded these, you know it's 47 because they don't take the day in and the day out in those 45 days. So the idea of dividend stripping is you're looking at not owning the shares, but you're wanting to own the shares at the time when the dividends are declared, and if possible, and to me it's really important, to get the franking credit. So what I will do is I will buy the shares, but I will sell a, excuse me, I will buy a put option and sell some call options to pay for it. But I will use European options to make sure that I can preserve the dividend and there's no exercise beforehand. Going back to these 0-day to expiry options, they obviously expire in a single trading session, and they have a slightly longer lifespan. This is the weekly, sorry. So with the weekly, I think these are fantastic because it just, first of all, you're getting the time decay, but also in addition to that, so you're getting that income every week. Okay, these option strategies have advantages and disadvantages, but one of the advantages is that you're trading at a lower risk exposure because you're looking at a short-term position. You don't have your overnight market risks, such as unexpected news or gaps. That can provide a sense of security and peace of mind, knowing your positions are going to be closed at the end of the trading day. So there's a psychological thing there. So we saw with Graham last month, he was inviting us to look at the trading, going into the trading game. So you can do that. And that brings me to the end. So if there's any questions, I hope I haven't confused too many people. I know with options, I wanted to try and keep it simple because the further you get into options, the worse it becomes. You sort of take a little bite. So just look at a very simple strategy. Make sure you do understand the options. If you do want to follow up on anything that I've said tonight, or you want to clarify anything, this is my email address, Darryl@methodandmadness.org. This is my education company. I've called it Method and Madness because I believe if you don't have a method, you will experience some degree of madness. I know I've got something in the chat box. Not all Australian options are American type. The answer, Graham, is no. That's why I trade European. Always. So that's the good news, Graham. Am I teaching options trading? Well, I will be, Darren. I'm going to probably wait until the new year, but if you want to follow me with options, yes, certainly. It's something I love doing. I've been doing it from the very beginning. I love them. Intellectually, I find them very interesting because of all of the different strategies. But I will say this, particularly with the iron condor, I was saying there were 4 legs. That's 4 amounts of commission. But there are, is it IG, IB? I think it's only like $2.50 commission on each contract. But yes, the answer, Darren, will be yes, but in 2025. Any other questions? Well, I'll just get a sip of water. Otherwise, oh, here we are. Weekly options is harder to adjust compared to monthly options if the direction goes wrong. Okay, Alan's raised a really good question. Let's have a look at this. So, what Alan is saying is weekly options is harder to adjust. We'll see what that means compared to monthly options if the direction goes wrong. Now, I really think this is an important question or statement, because when we say this trade did not work or the direction goes wrong, this is powerful. This is so important. So thank you, Alan. Because, see, if you've got a strategy, if you've got a written trading plan, the words right and wrong don't come into it at all. And I know it's natural and normal. I'm like everybody else. I haven't reached an enlightened period of time, but I do know in my own mind that if I think a trade has gone wrong, I know that it is reflecting beautifully my mindset. because we have two types of mindset, I believe, a certainty mindset and a probability mindset. So what I'd like is if my emotions come up or I have this thought, oh, this has gone wrong, then I know I'm thinking in terms of certainty. Because obviously when we go into a trade, we want the trade to be profitable. We'd be psychotic if we didn't want that. However, we will not always have a profitable trade. And I know when sometimes the trades are unprofitable, people like to talk about them as the cost of doing business. Personally, I don't like that term, because if I've got a business and I've got a cost aspect of it, I want to cut down on those costs. I want to reduce my costs. I can't eliminate them, but I want to reduce them. So what we're then trying to do is to see if we've got a methodology where we don't have that cost of business or we reduce it. So the biggest thing that I can talk about, and I notice we're getting up to time. It's I'm up here in Brisbane. It's only 6:57, but I know it's 7:57 down there. So I will wind it up at the hour. But it is about thinking in terms of probability. I know it's not easy, but one of the things that I've come across with my academic research is the concept of loss aversion. And I know from a practical point of view, we hate losses with a passion, me included. And so the work of Daniel Kahneman, Kahneman, and if you want to email me, I can give you some of the links to their paper, and Tversky. Daniel Kahneman won the Nobel Prize for his work with what's called prospect theory. That's a fancy word of just saying loss aversion. And just stopping there, Graham has just said both American and European options are listed on the ASX. Yeah, Graham, you're asking the question, yes. And I can tell you, how do you know it's a European option? We really need more time, don't we, for options? It gets too exciting. But if you've got a strike price, let's say we're looking at a Commonwealth Bank at a strike price of $144. That will be the American option. If it says $144.01, that's the European option. That's how we know the European option. So when you look at those strike prices, you'll see $144 and $144.01. Thank you, Graham. So just on that final point, and that is that, oh, hang on, talking about the options, I think there's been another question I didn't pick up, but loss aversion is really, really a big thing for us. We've got to acknowledge it, but very simply, at the heart of my research is very simply this. If we are unhappy emotionally or in any other way with our trading, I believe we're thinking in terms of certainty, not probability. So our emotions are a good thing. I don't like to manage emotions. There's a question here from Pablo. I was doing well selling options, mostly put options on the US shares, but in the last 12 months, it's been very difficult because individual stocks tend to crash even when the SPY is doing okay. Yeah. What are your favorite instruments to sell options? We'll see. I have to be honest, Pablo, I have to keep it very simple. I really only trade Commonwealth Bank options these days. I used to trade a lot of other ones, but I just stick to one. And it's interesting what you're saying, that even with any approach, you will find some shares will go as a herd, go up together, but there'll be others that crash. Why is it so? Because I believe every share has its own personality, and so the one strategy doesn't work across the whole portfolio. That's why I just like to choose Commonwealth Bank, because I think I understand it. Because I'm crazy, and I think sometimes Commonwealth Bank has got a crazy price. Any other questions before we go? Because we are going to that. I think that's about it. So look, thank you so much. I just so appreciate the ATAA, and so I really want to wish everybody safe and happy trading. And with that, I'll say take care and good night.